On your marks, get set, invest. In the previous episode, we looked at how to use fundamental analysis to help you find some tasty shares to buy. And so, well, hello there. It's my old pal, Low Risk. You look like you've got something to say to me, my nervous little chum. What's that you say, Low Risk? You're worried about picking your own shares? You think it might be too risky? Well, you know what, Low Risk? You've got a point. It's quite hard to keep your risk at a low level when you're picking individual shares. One way of dealing with that problem is to stick to shares in sectors where the companies are generally more reliable and slow-moving, like the utility companies that we mentioned in the previous episode. Companies that make steady revenues and profits and pay out regular cash dividends to their shareholders tend not to also see their share prices rise really fast, but the dividends alone can make them worth considering as low-risk investments. Another way to deal with the risk of shares is just to put less of your money into them. So a low-risk portfolio could consist of, say, mostly cash and government bonds and only a modest allocation to shares. That way you could even have a few high-risk shares in there. Well, it looks like someone's ears are burning. I wasn't talking about you, high risk. I was talking about high-risk shares within a portfolio that's low-risk overall. Oh, that cheeky little whippersnapper. So as I was saying, you could have a few shares in there with meteoric potential, and as long as you only put in a small percentage of your total investing money, even if one or more of those shares plummeted, it still wouldn't have much impact on your overall portfolio. Look, even though one of our shares has fallen by 95%, the overall pie, which is our investment portfolio, has only dropped by 1%. At ShareSoc, one of the greatest mistakes we see investors make is putting far too much money into one high-risk stock. People do this far too often. And when it goes wrong, the fallout can be devastating, both financially and emotionally. It can even impact investors' family relationships. I've seen it happen to people far too often, so you can avoid this by keeping at least some of your cash in lower-risk investments or in the bank. The other big method of lowering your risk is diversification, spreading your money around various different investments. Remember in episode 2, we talked about investing in funds that buy lots of different shares, and how by buying a chunk of that fund, you own a little chunk of all those different shares. Well, in this episode, we're going to look at how to compare different funds and choose the right one for you. And remember, if you have a private pension, perhaps your employer set one up for you, then it's already invested in stocks and bonds, and you've probably got money invested in funds too. So first, let's remind ourselves of the main types of fund: active funds and passive funds. Active funds are the ones where professional fund managers pick and choose what they think are the best investments, and then they put them all together in a packaged fund that you can invest in. Passive funds are those that simply track an index, like the FTSE 100 index, which contains the 100 biggest companies on the British stock market. However well or badly those 100 shares perform is how well or badly the FTSE 100 tracker fund will also perform. The big advantage of passive funds is they tend to charge lower annual fees than active funds. Now, when you're choosing a fund, here are the main categories you'll come across: investment trusts, open-ended funds, such as unit trusts, and exchange-traded funds, often known as ETFs. Investment trusts, first of all. They're companies set up to invest in other companies. You can buy the shares of an investment trust just like you would an ordinary share in a company. The manager of the investment trust invests in things like shares, property, small startup companies, all sorts of other things. And we can then do our research on the things the trust invests in. We can look at how the trust's shares have performed in recent years, particularly how volatile their performance have been. And so we can get an idea of roughly how risky it looks. By buying some shares in the trust, the idea is we can hopefully benefit from the growth of its assets. One thing you should bear in mind, though, is that you're not investing directly in all the properties and the startups and so on. You're getting exposure to those businesses indirectly by buying shares in an investment trust that buys those assets. And so the share price of the trust may rise and fall, just as any share price rises and falls, depending on how many people want to buy those shares and how many want to sell it. So, for instance, the share price may value the company much higher than its assets are actually worth. When it does that, we say it's trading at a premium. When the share price looks cheap compared to the underlying assets, then we say it's trading at a discount. Some investors like the idea of buying an investment trust at a discount because you're getting more in assets than you're paying for. But always bear in mind there might be a good reason for that discount. Perhaps people in the know are selling and so pushing the share price down because they happen to know that one of the assets in the trust is in financial trouble. So as ever, do your homework before you buy. The second type of fund, open-ended funds. They're not things that you can buy like shares on a stock exchange, so you don't need to worry about that premium discount issue. You buy them directly from your investment platform provider. They're called open-ended because they issue new shares every time someone wants to invest. And when the investor wants to sell their shares again, then the fund buys those shares back from the investor. As with investment trusts, the manager will invest the fund's money in all sorts of things. So you need to read up on that particular fund you're interested in beforehand to see whether it's really what you're looking for. There are lots of fund investment platforms regulated in the UK, so you can find information on sites like these ones. Or if there's a particular fund you're interested in, you can go to the website of the company that manages it, and there you'll find full details, including the annual performance of the fund over the past 5 years. You'll also find a full explanation of what kinds of things the fund invests in, and the various charges and fees to invest in the fund. Now, these can be very important because over years, high charges can sometimes really add up and make a significant dent in your investment's performance. And that's where the third type of fund really comes into its own. Exchange-traded funds, or ETFs. They're known for usually having relatively low fees, and this is because most of them are passively rather than actively managed. In other words, instead of having an investment manager who's paid lots of money to choose investments for the fund, ETFs usually invest automatically in an entire index, such as the FTSE 100, as we discussed in the second episode of this guide. Your money is invested in every single one of the 100 shares in the FTSE 100. So, ETFs are a little bit like investment trusts in that they have shares that trade on stock exchanges, and you can buy or sell those shares on the market in order to invest in the ETF. Now our risk characters understand the difference between the different types of fund. But they're still none the wiser about which ones they should actually invest in. As I said before, investing in a typical fund tends to be generally less risky than sticking all your money in just one share, because the fund diversifies your risk across various different investments. But of course, those investments might in themselves be very high risk. Oh, look, someone's excited. Okay, well, let's see what we can find for you, shall we? How about a private equity fund? A private equity fund usually invests in high-risk, high-potential return companies, companies that you can't get access to directly through the stock market, so you buy the private equity fund instead, which then invests in those companies. Or how about a venture capital fund, investing in small startup companies with big potential and big risk of bankruptcy too? Hopefully, the winners will outweigh the bankrupt failure companies in this fund. It's kind of a bit like being one of those dragons on Dragon's Den. So, okay, you take those, and now let's find something for medium risk. Right, a global equities fund and a bond fund. The Global Equities Fund will track a sample of shares from stock markets all over the world. This lowers your risk because you're investing in shares from lots of different industry sectors in lots of different countries. So hopefully losses in one country or sector will be balanced out by gains in another country or sector. But, equities are always risky because sometimes all the world's stock markets crash at the same time. So as you're not high risk, we need to allocate a chunk of your cash to something less risky, such as a bond fund, which we talked about in episode 2, remember? A bond fund effectively lends money to governments and big companies in return for regular interest payments and a promise to pay back the loan to you after a number of years have gone by. Of course, though, you can sell your fund anytime you want. You don't need to wait for the government to actually pay their loans back. You simply sell your investments to someone else through the markets. There, now off you go. Oh, come on now, low risk. Don't be frightened. I'm sure I've got something that will suit you. Here is a low-risk government bond fund. It probably won't provide much annual income or growth, but it's considered a low-risk investment because big governments tend to pay their debts to you on time. And how about a low-risk dividend fund too? It contains lots of the most reliable shares that pay regular dividends, and their shares don't tend to rocket or crash quite as dramatically as many other shares do. There you go. Now, the final thing to bear in mind when investing in any of these funds, even if you've researched them really well, is that while the annual performance figures are a pretty good guide to how volatile your returns are, the future is not necessarily going to be the same as the past. Just because a fund returned 15% a year for 5 years, it doesn't mean this performance will necessarily continue. Just like stocks, but perhaps they are less volatile. People often get blown away by the impressive performance of a star fund manager who inevitably gets paid lots of money, but history shows us that star fund managers rarely outperform their peers for long periods. They usually have a good few years, so then everyone piles into their funds, and then their performance tends to return to the average. Perhaps they were on some kind of winning streak like an athlete. Perhaps they were just lucky. But the lesson is, take past performance with a pinch of salt. So let's recap, shall we? Funds help you diversify your investments more quickly and easily than researching and buying all your shares yourself. But you will pay fees to the fund manager. Funds can be actively managed or passive. The main fund types are investment trusts, open-ended funds, and exchange-traded funds. ETFs tend to have the lowest fees because they're usually passively managed, investing automatically in all the shares in a particular index, such as the FTSE 100 or the Dow Jones 30. Funds can be higher risk if they invest in things like private equity or venture capital funds, which invest in young startup companies. They can be medium risk if they invest across the world's stock markets, as well as in bond funds. And they can be low risk if they invest mainly in government bonds and solid dividend-paying shares. Now we've talked about what kinds of things there are to invest in the next few episodes, we're going to look at when to invest, how to estimate the best times to get in, and crucially, when to get out.